The Fed may only need one more data point to cut rates. Thursday's CPI may hold the final key to the puzzle. To set this up, we have to look at last week's jobs numbers. Employment is certainly on the decline. Non-farm payrolls was released at a level of 206,000. This is again reported in thousands, following last month's 218,000. Over time, we can see a steady decline in non-farm payrolls. And this applies to all segments of non-farm payrolls. Well, almost all. There's one exclusion. Non-farm payroll services on the decline, 187,000, falling short of last month's 206. Non-farm payroll goods also on the decline, 19,000. That's a little bit of an uptick from last month's 12,000, but over the long term, we can see this number is heading lower. The obvious exclusion to this is non-farm payroll government. For some reason, government jobs seem to be on the rise, 70,000 versus last month's 25, and higher than we've seen in actually quite a while now. In terms of the job openings, this is even more of a stark message. This is reported from the JOLT survey, again reported last week. This is reported in thousands, so we have 8.14 million. That's a little bit better than the prior month, 7.9, but certainly a very sharp decline to the downside over the past couple of years. Compare in red non-farm payrolls to in blue the JOLTS job openings. The takeaway from this is very simple. As the job openings go down, so do the non-farm payrolls. There's an obvious correlation here. There's not a lot to look into this. Overall, we see employment conditions are worsening. Now, why is this important? The Fed may only need one more data point to cut rates. They have a dual mandate. One is stable employment, the other stable prices. Question: what did the economy look like when the Fed finally cut rates during the last recessionary period? We're talking again, of course, about the 2007-2008 level. Do these numbers that we see today, do they justify a rate cut? Well, let's look to history. This is in 2007, 2008. Now in blue, notice that's the Fed funds. We cut from 525 to 475. What we want to know in red is what the non-farm payrolls look like just approaching that Fed cut. Non-farm payrolls, 79,000, 86,000, a negative 25,000 as well. So certainly it was in much worse, I don't want to say much worse. Again, we're seeing levels in the low 200s, and here it's between 0 to almost 100. Non-farm payrolls was in a worse situation back then, but not by a tremendous degree. Now, we could ask ourselves, where are we now? Again, non-farm payrolls, the latest number, 206, 218 prior to that. Prior to that, 108. So non-farm payrolls is not that much better than where we were right at the point when the Fed really started to cut rates in 08. We can take a look at the JOLT survey. Again, this is the job openings in red. Notice again, focus in on the point when the Federal Reserve cut rates from 525 to 475. What did the JOLT survey? Now, these are year-over-year comparisons. How did the job openings situation in 2007-8 compare to what it looked like a year prior? 1% year over year, flat, negative 1.6%, negative 2.9%. So certainly on the decline, barely in the negative territory. What do the JOLTS job openings look like now? Actually, much worse. The current number, negative 12.6%. Again, that's on a year-over-year basis, following last month's negative 20%. So the job opening situation is actually much worse than when it was in a 2007-2008 cycle just prior to the rate cut. And if you follow the anatomy of the economy, if there's less job openings today, certainly we see that. Will that translate into worse non-farm payrolls in the months to come? We could also consider the unemployment rate. And again, notice just at the point when we cut rates from 525 to 475, what did the unemployment rate look like? 4.6%, 4.7%. Where are we now with the unemployment rate? Well, it's rising, not at that level, not 4.7, not 4.6, but it is rising 3.9, 4.0, 4.1. By the way, in a few days, we're going to talk about a really interesting, very not very well known survey or an economic theory that attacks the unemployment rate. It's going to be a lot of fun, so stay tuned for that. Now, Fed funds. This is the big question on everyone's mind. The CPI, it's due Thursday, focusing on 525 to 475 cut. What did the CPI look like in the '07 cycle? 2.7%, 2.3%, 1.9%. Now you'll notice these low CPI numbers occurred prior to the Fed cut. There is a little bit of a delayed reaction in the sense that the CPI is reported a month late. So just keep that in mind. That's why we see a little bit of a delay in the data. Now, currently, Fed funds in purple, CPI, we're currently 3.3%, following last month's 3.4%. Now, we could make the argument the inflation cycle this time around was a lot stronger than what it was in 2007. There was inflation back then, but we didn't hit the hot, lofty levels we saw, just in the past couple of years. So maybe that's why we're a little bit higher now. But nevertheless, CPI is on the decline. Keep in mind, these are the current odds that the Federal Reserve will cut rates in September. They're not cutting in July. There's almost a zero probability. But notice in particular, on July 5th, 78%. That's when we hit our peak. That shows us a 78% chance Federal Reserve will cut rates in September. It's backed off from that level, but not by a large degree. We're still in the 70s. What happened on July 5th? Non-farm payrolls. You see, at the moment, the markets and the economy, Fed funds futures, the bond market, we're all watching two big key economic barometers: jobs and inflation. The jobs numbers that were released on July 5th spiked up those Fed funds futures with a probability that the Fed would cut rates because the jobs market and the job openings are declining to such an extent. So the real question at the end of the day is that will the CPI number come out low enough where it will arm the Federal Reserve with the ability to cut rates in September? Question, please let us know in the comments. If the CPI continues to decline, should the Fed cut rates in September? We're at 3.3%. What is the CPI number we want to see in order to justify a Fed cut in September? We thank you for joining us. We look forward to seeing you back soon.